Tonight, the market is sending a warning few investors expected. Bitcoin is falling hard, gold is no longer behaving like a safe haven, and trillions of dollars are shifting across global markets. What does this sudden crypto crash really mean, and why are even traditional assets feeling the shock? In this report, we break down what triggered the sell-off, how institutional money is reacting, and whether this moment marks a temporary correction or a deeper turning point for the global financial system. Stay with us as we uncover the forces driving fear, opportunity, and the future of digital and traditional wealth.
Bitcoin's recent decline is not simply a short-term price dip. It reflects a convergence of macroeconomic, structural, and market mechanics pressures that have fundamentally shifted investor behaviour. At the core is a tightening global financial backdrop. Expectations that the US Federal Reserve will maintain higher interest rates, in part driven by political developments such as the nomination of a new Fed chair, have strengthened the US dollar and reduced liquidity. Higher rates make riskier assets like Bitcoin less attractive, prompting capital to rotate into safer instruments such as cash and bonds. Simultaneously, institutional participation that once buoyed prices is waning. Large investors and Bitcoin-linked ETFs have recorded significant outflows, removing a key source of demand and accelerating selling pressure. Technical market mechanics have also intensified the downturn. When Bitcoin broke key support levels, forced liquidations of leveraged positions triggered automated selling, creating a self-reinforcing cascade that amplified losses. Combined with geopolitical uncertainty and broader risk-off sentiment in global markets, these factors underlie a multi-layered sell-off that goes far beyond surface narratives of a crypto crash. The current sell-off is putting unprecedented pressure on the long-standing idea of Bitcoin as digital gold, a narrative built on scarcity, independence from governments, and protection during economic stress. In theory, Bitcoin was expected to behave like gold during market turmoil, holding value or even rising as investors sought safety. Instead, recent price action has revealed a different reality. As global markets turned cautious, Bitcoin fell sharply alongside equities and other high-risk assets, while gold proved relatively more resilient. This divergence has exposed a core weakness in the digital gold argument. Bitcoin is still deeply tied to liquidity conditions and investor risk appetite. When money is cheap and confidence is high, Bitcoin thrives. When liquidity tightens, it sells off aggressively. A pattern far closer to growth stocks than to a traditional safe haven. Institutional behaviour has amplified this contradiction. Large funds and ETFs increasingly treat Bitcoin as a tactical trade rather than a long-term hedge. When volatility rises, these players exit quickly, accelerating losses. Gold, by contrast, benefits from central bank demand, long-standing trust, and centuries of use as a store of value, advantages Bitcoin has yet to fully establish. The sell-off has also highlighted Bitcoin's short history in true financial stress. Unlike gold, which has weathered wars, depressions, and currency collapses, Bitcoin has existed primarily in an era of accommodative monetary policy. This downturn is testing how it behaves when capital becomes scarce and fear dominates markets. None of this means Bitcoin has lost relevance. Its fixed supply and decentralized design remain unique. However, the recent crash suggests that Bitcoin is not yet a mature safe haven asset. For now, it functions more as a high-volatility alternative investment, one still searching for the stability required to earn the digital gold title. The recent market turmoil has revealed the often overlooked forces quietly shaping Bitcoin's trajectory. Interest rates, the strength of the US dollar, and the behavior of institutional investors. Together, these factors form a powerful undercurrent that has intensified the sell-off. Interest rates sit at the centre of this dynamic. When rates are low, borrowing is cheap, and liquidity flows freely into speculative assets, including cryptocurrencies. However, the persistence of higher-for-longer rate expectations has reversed that flow. Elevated yields on government bonds now offer investors a safer, predictable return, reducing the incentive to hold volatile assets like Bitcoin. As capital becomes more expensive, risk tolerance shrinks, and crypto is often the first asset class to be trimmed. Closely linked is the strength of the US dollar. A stronger dollar tightens global financial conditions. especially for international investors who must convert local currencies to access dollar-denominated assets. Historically, Bitcoin has struggled during periods of dollar strength because a rising dollar absorbs global liquidity, leaving less capital available for speculative markets. The current dollar resurgence has therefore acted as a silent drag on crypto prices. Institutional investors have further amplified these pressures. Unlike early retail adopters driven by ideology or long-term belief, institutions operate under strict risk management rules. When volatility spikes or macro conditions deteriorate, they reduce exposure quickly. Recent outflows from Bitcoin-linked funds and ETFs suggest that many institutions are treating Bitcoin as a trade, not a sanctuary. This collective retreat matters because institutional money has become a dominant force in crypto markets. Their exits remove liquidity, deepen price swings, and influence sentiment far beyond their actual holdings. In this environment, Bitcoin is less insulated from traditional financial forces than once believed. Ultimately, the sell-off underscores a critical reality. Bitcoin now operates within the same macroeconomic ecosystem as global finance. Interest rates, the dollar, and institutional capital are no longer peripheral influences. They are central drivers of its fate. This moment carries very different implications for retail investors, long-term holders, and global markets. And understanding those differences is critical. For retail investors, the sell-off is a stress test of expectations. Many entered the market during periods of rapid gains, assuming volatility was temporary and recoveries inevitable. The current downturn highlights the risks of overexposure, leverage, and short-term speculation. It reinforces the importance of disciplined risk management, realistic time horizons, and the recognition that Bitcoin can experience prolonged drawdowns, not just sharp rebounds. For long-term holders, the situation is more complex. While price declines are painful, they also serve as a reality check on Bitcoin's role within a tightening financial system. Long-term investors are being forced to reassess whether their conviction is based on fundamentals, such as scarcity and decentralization, or on past performance shaped by easy money. For some, this period may strengthen belief. For others, it may prompt strategic rebalancing rather than blind holding. At the global level, the sell-off signals a broader shift in market psychology. Bitcoin's decline alongside other risk assets shows how interconnected digital assets have become with traditional finance. Rather than acting as an escape from global markets, crypto is increasingly reflecting them. This integration means that future crypto cycles will likely be driven less by hype alone and more by macroeconomic forces. Ultimately, this moment is not just about falling prices, it is about maturity. The crypto market is being forced to grow up, and investors at every level must adapt accordingly. The critical question now facing investors and policymakers alike is whether this downturn represents a temporary reset, or the early stages of a new financial era. Market history suggests that major sell-offs often serve as inflection points, clearing excess speculation and forcing a reassessment of value. In that sense, the current decline may be flushing out weak hands, excessive leverage, and unrealistic assumptions that accumulated during years of easy money. However, this moment also hints at something more structural. Bitcoin and other digital assets are no longer operating on the fringes of finance. They are increasingly shaped by the same forces that govern stocks, bonds, and currencies. This integration means crypto's future may be less about rebellion against the system and more about coexistence within it. Regulation, institutional participation, and macroeconomic discipline are no longer optional. They are becoming defining features. For global markets, this evolution could mark a transition from speculative experimentation to selective adoption. Projects with real utility, transparency, and resilience may survive, while others fade. Investors, meanwhile, may begin treating crypto not as a guaranteed hedge or shortcut to wealth, but as one component of a broader, diversified financial strategy. Whether this is a reset or a new era will not be decided by price alone. It will be determined by how markets respond to scarcity, trust, regulation, and discipline in the years ahead. The answer is still unfolding, and the consequences will shape finance far beyond crypto itself. In cryptocurrency trading, the strongest emphasis should be placed on risk management, market discipline, and macro awareness. Traders must understand that crypto is highly volatile and deeply influenced by interest rates, liquidity, and investor sentiment. Proper position sizing, stop-loss strategies, and avoidance of excessive leverage are essential for survival. Emotional trading, driven by fear or hype, often leads to losses. It is equally important to distinguish short-term speculation from long-term investment, and to base decisions on data rather than narratives. Above all, traders should accept that preservation of capital matters more than chasing rapid gains in uncertain markets.
As markets continue to shift and certainty remains elusive, staying informed has never mattered more. Thank you for trusting us to break down the forces shaping your financial world. If this report helped you better understand what's happening beneath the headlines, we invite you to like the video and share your thoughts in the comments. Your perspective matters, and your engagement helps this conversation grow. I'm Stacey Agatha. Thank you for watching. We love you. Bye.